Hello everyone, and welcome to seventh lesson in Area Study 2, our third one on full employment. We're going to be looking at recent aggregate demand side factors which have impacted full employment or the unemployment rate. Following on from when we looked at measuring the labour market, whether it be the unemployment rate, the labour force participation rate, underemployment rate, underutilization rate, etc. All those different measures that we look at to see how the labour force is performing or how the labour market is looking overall. And from before that, of what the goal of full employment is, which is the lowest rate of unemployment possible, consistent with no unnecessary inflationary pressure, around 4.5 to 5% natural unemployment occurring. So we're going to get straight into this with our key knowledge, which is all about aggregate demand, aggregate supply side factors that have influenced inflation, economic growth, and the unemployment rate over the last 2 years. Really for this, we're just looking at aggregate demand side factors that have influenced the unemployment rate over the last 2 years. Pretty broad key knowledge that covers all of the topics. We're specifically honing in on these ones. We're going to look at just briefly a general overview of things that have happened in the last 2 years that have impacted aggregate demand and therefore unemployment. And then we're going to look at a few different aggregate demand side factors that we have real data for to talk about how that would have directly impacted the unemployment rate. So let's go with the first general overview that we're going to look at. So due to the impacts of the COVID-19 pandemic in 2020 and carrying on to 2021, there's been a significant decline in aggregate demand as consumers feel less confident about the future and chose to increase their private savings and limit private consumption spending. We've got a whole lot of different charts that are going to show exactly that in a moment. Also, really early on in 2020, which is still relevant, we had the massive bushfires, which greatly damaged tourism, greatly damaged a lot of our natural resources, and limited overall spending and demand in those areas as well, because it negatively impacted tourism. So some key points. Structural unemployment's increased significantly due to lockdowns, restrictions, causing businesses to close permanently, meaning that people are earning less income, less spending, less aggregate demand, etc. More unemployment in general leads to more unemployment. The government implementing JobSeeker, which was then doubling welfare payments or transfer incomes, which helped stimulate private consumption spending during 2020. However, that's now reverted back to its original levels. So it could be interesting to look at how, although it has benefited unemployment and brought unemployment levels down recently, it could actually move in the opposite direction coming up very soon. Then lastly, closed borders has led to a decrease in tourism exports, as therefore created increased levels of unemployment in the sector. Also, the Australian dollar has been increasing a fair bit recently. It's up to about 78 US cents, meaning our exports are more expensive and imports are cheaper for us, which can lead to more leakages and less injections into the economy via aggregate demand. So we're going to get into a few aggregate demand side factors one by one and talk them through about how that would impact unemployment. So business confidence, you clearly see when the lockdowns happened, we had this massive drop to below negative 60 index points. During that time, businesses were being forced to close from lockdowns, or they were choosing to close permanently, therefore laying off workers, greatly increased levels of unemployment due to that. So less private investment spending, less aggregate demand, and therefore massively increased unemployment rates. You can see since then, business confidence has been steadily increasing. So as that happens, businesses are conducting more private investment spending, which means more injections to aggregate demand, and therefore that decreases the unemployment rate. So overall, recently, unemployment's been falling because businesses are more confident, they're investing and expanding, increasing their production, demanding more labour resources, and therefore decreasing the unemployment rate. Look at consumer confidence, fairly similar. Consumer confidence had two dips for the two different lockdowns that we had, or two different major waves that we had throughout Australia, specifically Victoria. From this, you can see that during these times, unemployment increased quite a lot as consumers slowed their private consumption spending and began private saving a lot more, which increases leakages in aggregate demand, therefore decreases aggregate demand, increases the unemployment rate as businesses lay off workers, as they don't need to produce as much. But you can see recently we've had a large increase in consumer confidence until it's reached quite high levels compared to any time in the past. Probably higher than it should, but either way, during that time, it means that there's going to be more private consumption spending and less saving, and therefore that's going to mean more aggregate demand. More aggregate demand is going to send a signal to businesses to increase their production. They're going to hire more people. That is a big, big letter D. And then that is going to decrease the unemployment rate because consumers being more confident means there is more spending, and therefore less unemployment overall. I'm trying to do this with a trackpad rather than my actual drawing tablet today. A lot harder to write down letters. So that's it for consumer confidence. Pretty clear based on that there. Household savings ratio. So this one's pretty important to kind of like it tees up really nicely what we just talked about with consumer confidence. That in kind of the middle two quarters of 2020, so the July quarter and the September quarter, you can see that household savings ratio increased quite a bit in comparison to any time in the past. Usually it was around that like 3.5 to 4%. And then you can see it jumped up to 22% and 18.7%. So you can see that's a massive increase in savings, private savings, which means there's going to be less aggregate demand. And in that time, that's going to mean greater levels of unemployment, layoff workers. So obviously that's starting to fall a little bit now as people are spending more. As it begins to fall, that's going to mean less private savings, more private consumption spending, therefore more aggregate demand, and therefore more employment is going to occur because of it. Then we've got government spending. This one's pretty clear. Government spending in general has been just increasing over time. Government spending being an injection to aggregate demand, but more specifically recently, the increased spending on infrastructure projects and all of those areas is going to, either way, increase G is going to mean increased aggregate demand, but also all of those jobs directly create jobs and therefore will decrease the unemployment rate. So the increase in government spending is going to increase government spending, therefore increase aggregate demand, send a signal to businesses to increase their production, employ more labour resources, and therefore decrease the unemployment rate. Sounds pretty clear. The cash rate, so interest rates being, the cash rate being the interest rate the RBA charges banks, then banks charge an interest rate which is slightly higher so they can make a profit. This is at 0.1%, which is the lowest it's ever been in history in Australia. This means that it's very cheap to borrow money, as you will not have to pay back as much in interest, and you do not have as much incentive to save. So theoretically, this should mean that private investment spending and private consumption spending increase significantly, meaning there's going to be increased aggregate demand and therefore decreased unemployment rates. However, in actual fact, the cash rate hasn't been that effective. As you could see in the previous slide, household savings still increased quite a bit when interest rates were at really low levels, but that's the intended effect for it. And lastly, we've got the exchange rate. This is the exchange rate as of the 20th of April, 2021. It's at 77.6 US cents. That's relatively high to what it's been in the last couple of years. So it was around 65, 63 US cents early last year. So since then, it has been steadily increasing. And as our dollar increases, there's going to mean less exports and more imports, which is obviously bad for unemployment. It's bad for aggregate demand first, and that is going to send a signal to businesses to lay off workers, especially in exporting industries, and that is going to increase the unemployment rate theoretically. Because of that increase into the Australian dollar. We'll look at that from aggregate supply side perspective in the next video that we do, and it's going to have a very opposite effect there. But that's the aggregate demand perspective in terms of the theory of how that exchange rate is going to impact the unemployment rate. All right, so that is it for recent demand side factors that have impacted on unemployment in the last 2 years. If you have any questions about these, feel free to comment, leave me a message. Head to my website, www.therunningeconomy.com, read some blogs, buy some resources, join the Discord where there is many students writing incredibly intelligent responses to questions. You could learn a thing or two from them. There is also some incredibly helpful teachers on there who answer questions in their own time because they're just nice people, which is incredible to me that they're willing to do that. And they should be thanked for that on a regular basis. Other than that, I hope you have a wonderful day and you are easing back into the school term, even though you're probably doing this in like week 3 or 4. On that, have a wonderful night and I'll see you next time.